Hey everyone, it's Friday, April 21st. Today on the Final Bar, we will wrap this week. We'll look at how the markets evolved over the course of the week. To be honest with you, a lot of noise, but at the end of the day, how much did things evolve? Well, it depends on what you're looking at. You're looking at crude oil, you're looking at Bitcoin. Kind of a painful week. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. I'm thinking back to some of the conversations we've had through the course of the week with some fantastic, very accomplished technical analysts, people like Craig Johnson, Dan Russo, Ari Wald. All of them I've known for a number of years, and it's great to see their similarities, I guess, in their toolkits, but also the differences, right? You heard a little more of a negative vibe from Dan Russo yesterday, a little more of a constructive vibe from Ari Wald. That's what makes a market. That's what I always was told when we would bring in a practitioner using a similar toolkit but drawing different conclusions, right? That's why it's not all straightforward. It's not all completely clear. At the end of the day, it depends on what we're looking at. It depends on how we weight different pieces of evidence. And at the end of the day, where we place our bets. And I would argue that the most important thing is not to know the answers ahead of time. It's to ask questions along the way, and it's to admit when you're wrong. And hopefully through the course of the show, we reinforce the benefits of using charting and technical analysis tools to help you recognize when you're wrong, right? When your position's no longer working, and have the courage, the conviction to take action. We're going to go through a lot of charts, and let's start with our market recap, what we call the Wrap the Week segment every Friday. We are going to start with a poll, though. We always have a poll going on our live stream page at StockCharts.com. We asked you recently, in your opinion, what's the probability that the S&P 500 ends 2023 over the 5,000 level? And I intentionally gave us a pretty aggressive target. That's up there quite a bit. Over half of you, just over half, said below 30%. Highly unlikely that we would get up to that point. 21% of you said 30 to 50%, which means about 72% of the respondents in our poll basically said less than a 50% chance. 6% of you, and this is what's really interesting to me, 60% or 6% of you said over a 70% chance that we would get 5,000. That is a serious bull case right there. I would love to think about and argue what would need to happen for us to get to that point. But really, the point of these sort of questions isn't to predict and isn't to declare a winner as to who predicts it correctly. It's more to think about probabilities and what we call probabilistic investing. None of us know what's going to happen tomorrow, much less the end of 2023. But what we all can do is think about those different options. That's what sets humans apart, our ability to think creatively, to think about potential future paths and sort of critique and consider different points of view. I would encourage you to use charts to think about some of those different scenarios and what a move above 5,000, what a move below 2,500, which is probably equally as unlikely but possible. What would that do to a portfolio, to the benchmarks, to the sectors and themes that you're looking at? Great, and thanks so much for answering our poll question. Let's get to the Wrap the Week segment, continue on looking at what happened today. Here's what we like to do on a Friday. Let's check in on what happened with the markets today. We'll just look at the quick returns here. We'll look at the last 5 trading days, look at the week, and see what all took place. And then we'll get into some of the charts and themes that I think are most important as you head into your weekend here. As we're looking at the major averages today, again, a lot of unchanged, right? Unch is the word I would use to describe a lot of this week. And it's interesting. Underneath the hood, there are a lot of stocks and groups that are moving. And even today, we'll talk about Amazon breaking above its 200-day moving average. Stocks like Valero breaking below their 200-day. So things are happening. But at the end of the day, it's netting out to the major averages being sideways. The S&P, the NASDAQ composite, the Dow, essentially not too far off of where they were on Thursday's close. Mid caps and small caps a little bit in the red, and small caps maybe the worst performer, but not by much, only down about 1/3%. volatility continues to decline. And this is something I'm debating more and more with some of my friends and peers in the industry. Very interesting to note that the CBOE just announced this week, I just found out about it earlier today, they will be releasing a one-day VIX starting on Monday of next week on April 24th. We're actually getting that data. We'll make sure we get it ready for you as soon as we can, and we'll share with you how to watch it on this, how to follow that on the show. But a lot of the debate about the VIX has the VIX changed so much because of the short-term options, the 0 days to trade expiration, 0 DTE options. I would argue the fact that the CBOE is now releasing a new VIX just for the short term probably tells you there's something there to pay attention to. So we'll dig into that data as soon as we can and share some insights with you the best as we're able. Interest rates overall moving higher, pretty much across the curve from the short end all the way out to the long end. The 10-year point, which we track the most, is currently around 3.6%. 5-year point just a little bit above there. Same with the long bond. The dollar index, not too much change from yesterday, down about 0.1%. So it's essentially unchanged as well. With commodities, not a big change to worry about, although on a day of relatively low percentage moves, gold, silver, copper, all down over 0.5%. That's pretty much the worst performer sort of things I could find. Corn maybe doubling that to the downside, but for the most part, risk assets were fairly stable. But gold and silver, which are trades that we've been talking about, that we've been following with a number of our guests, actually down about 0.8 to 1% just today. Cryptocurrencies continuing to decline. I think that's a really important theme to be aware of going into the weekend. You can see the little preview chart sort of slip sliding down here as we're going live with the show over the last couple hours starting to prepare for it. Bitcoin right now at 27,210 or so, down about 3.7% from yesterday. Ether price is down about 5.5% to 1837. Again, look at the 2-day chart of Bitcoin just continue to go lower. In a moment here, I'll show you the longer time frame of Bitcoin. You'll see why that's kind of an issue. Here's what we call our wrap the week chart. This is starting the clock at last Friday's close and then looking to where we are today. And one of the benefits of a weekly routine, and my weekly routine usually starts on Thursday into Friday, continues with my weekly flight plan report for my Market Misbehavior Premium members that continues on into Monday with sort of the last parts of that weekly piece. But a weekly routine is super important, and I think it's a great opportunity to, now that the markets are closed for the week, what changed? What all did we learn this week? Well, here's what we learned in terms of price evolution over that period. The S&P flat from last Friday. So I keep reinforcing a lot of these days are like unchanged days, right? Not a big movement. Literally, at the end of the week, the S&P is pretty much where it was 1 week ago. But you'll see all these other lines are farther and farther away from that. That shows you that underneath the hood, other things are moving. It's just not the major benchmarks right now. They're netting out to sort of a flat return for the week. The dollar was up about 0.25%. In purple, this is the small cap ETF, the Russell 2000 ETF, which was up 0.6%. Everything else was down for the week and underperformed the S&P. Clustered together here, you have the NASDAQ 100 in pink, and then in brown we have, this is sort of the reddish color, you have TLT, bond prices, both down about 0.6%. In gold, this is gold prices, the GLD down 1.1%. In orange, emerging markets down 1.8%. Crude oil, by far the worst performer out of this group, down 5.4%. Have you noticed what's not on this chart though? Cryptocurrencies. And when we add Bitcoin in the mix, you'll see it was actually a pretty painful week. Bitcoin currently down about 10.5% from last Friday. And what concerns me is that the last 3 days have been sort of a waterfall decline. It's not like you're just getting a big drop and then buyers coming in and pushing the price higher, which is kind of what you got on Friday's session with crude oil prices. You're getting the opposite. You're sort of, selling begets further selling. It's sort of a feedback loop of negativity, and cryptocurrency is really starting to pull back. Now, the larger structure, I would argue, is probably still okay, but in the short term, back below 30,000 with no short-term floor in sight that I could detect. Let's look at a couple other charts here. We're going to look at the S&P chart. The daily chart. We've hit this chart pretty regularly on this on the show. I think it's a great place to just sort of come back every day and just think about how things have evolved. Again, not much change this week. This week was sort of a choppy week. And if you look back to the end of March, that was sort of the big move, right? That was the rally off support at 3,800. We broke just above 4,100, pulled back, and then rotated higher. From there, really from that initial break above 4,100, that's kind of still where we're at, right? We're sort of haven't really gone any further to the upside. We've traded around an equilibrium price around 41.30-ish, we'll call it. So at this point, right, what does this tell you? I mean, the chart's not broken, right? It's certainly not going down, but it's certainly stalled in its attempt to move higher, right? We keep sort of pulling back to that same level. So one of two things is going to happen here probably in the near future. Option one, sort of the bullish scenario, we power above 4,200. That certainly could happen next week. We've had a lot of earnings this week. Next week, of course, even more. We're sort of in the fire hose phase of an earnings season. The next couple of weeks are going to be pretty heavy with some mega cap names reporting pretty much many days during the course of the week. So plenty of possibilities that could drive the market higher and could push the S&P above 4,200. I think that's pivotal because the S&P gets above 4,200, the NASDAQ breaks above its February high, and you have what's called a new Dow theory buy signal, which is when both of those indexes are breaking above their most recent highs. At this point, it's sort of a wait and see mode to see if that's able to happen. Now, the other scenario, the sort of risk off scenario, is that we fail at 4,100, we fail to hold that. I would say that also means we continue to push lower back into this range that we've established over the last 5 months or so. And again, there's downside there to about 3,800. I think we could get down to that point and still sort of be within this broad consolidation pattern. But again, it's all about, do we follow through and continue to push higher? This week, we did not. We sort of stalled out here. And so I think at this point, the bullishness that we certainly saw in previous weeks has sort of evaporated or lightened up a little bit. Now, there are other charts we can use to sort of measure that overall environment. One of the things I want to mention is the McClellan oscillator. This is a chart I get a lot of questions about. The color coding that I added to this a little while ago really resonated with me, and I think it's resonated for a lot of you as well. Just to update you on where we're at. I was watching this real time. I don't believe it's gotten below the zero line, but we'll have to see as we lock in all the closing data for today if we do get below zero. We may certainly do that. And if so, if that happens, and I would check this chart maybe a little later in the evening, once we've updated all of the breadth data. So we wait for all the official closes, make sure we have the right data before we update our main breadth indicator database. We get below zero, that all of a sudden starts to look like previous toppy patterns, and you will hear my voice become a little less constructive next week for sure as we sort of describe this potential rotation to the downside. I mentioned a couple other random charts I just want to highlight for you. You know, moving averages are so simple but so meaningful because they're just a great visual way to recognize when things are shifting. And two charts that I wanted to share with you that are actively engaging with their 200-day moving average, which means they are right on the edge of being either very bearish or very bullish, depending on what happens. Amazon closed right almost to the penny at its 200-day moving average today. We're right about at that level. We have not closed through it. We have not closed above it and gone above it for another day since back here in late March, and that only happened for 2 days. Really, we've been below the 200-day moving average since the end of 2021. So that would be a big change for a significant stock to make a higher low in March and then break above the 200-day moving average. So that might be a stock to watch going into next week. On the other side, you have stocks that are breaking down through their 200-day moving average. Today, Valero closed below its 200-day. The last time that happened was in September of last year, which ended up being a bounce soon after. We rallied right after this. But usually breaking below the 200-day is often a pretty negative sign for a stock. In the energy space, which has been struggling certainly on a relative basis. So two names actively trading around a key long-term barometer, the 200-day moving average. So let's take a quick break. We'll be back answering some of your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's a pleasure to put this show on for you. We have a really good team here at StockCharts TV, Skybogs, and the rest of our producers and engineers making sure that we can bring this out to you. We're going to have a lot of fun using this studio space more and more over the coming weeks and months. We're excited to share some of that with you. A couple quick announcements before we continue on with our show. Our mailbag, which we're going to light up here in a few moments, is all driven by questions from people like you. If you could email us your questions, thefinalbar@stockcharts.com, that'd be awesome. You can also tag us on Twitter @FinalBarSCTV. Or put a comment below the video you're watching on our Stock Charts YouTube channel. We'd love to hear from you and hope to answer your question live on the air next week. By the way, next week I will be out going to New York with some of the Stock Charts team. We will be sponsoring and engaging at the CMT Symposium 50th anniversary in New York. We'll come back to that in a minute. Tom Bowley has graciously agreed to guest host the show. He'll be answering some of your questions this coming Monday. Tuesday, Wednesday, Thursday, he has 3 really good guests for you, longtime Stock Charts contributors. Bruce Frazier on Tuesday, Arthur Hill on Wednesday, Aaron Swenlin on Thursday. Next Friday, the 28th, we have the privilege of coming to you live from the studio or live from the stage at the CMT Symposium. This is the 50th anniversary of an organization that Ralph Acampora and John Brooks started in 1973. It has become such a pivotal part of the industry for so many, myself and others, who have been able to take what they started and build on that and have successful careers. Analyzing the markets using technical analysis. So it'll be a great opportunity to get the community together. I will be interviewing Ralph Acampora and Luis Yamada, polling the audience and discussing as a group. It's going to be a lot of fun. So we will be coming live on Friday, the 28th at 1 p.m. Eastern from the stage at the CMT Symposium. So look forward to seeing you there. Let's continue on our show today with the Final Bar mailbag. Please keep your great questions coming to us via email, thefinalbar@stockcharts.com. Here's question number 1. Do you use multiple time periods to decide your entries and exits? Part of me is saddened with this question because I feel like I haven't done my job reinforcing the benefits of using multiple time frames. So just to be clear, absolutely 100%, I'm a big fan of multiple time frames. As a matter of fact, I'm going to be talking with Brian Shannon, who literally was one of the people that wrote a fantastic book on multiple time frames. His most recent book on anchored VWAP is what we'll be talking about in New York. But he and others, Joe Rabel, one of our StockCharts contributors, has also done a lot to popularize this concept of multiple timeframes. This is using our StockCharts ACP platform. I don't show this a ton on our show here. We will probably be using this part of the StockCharts platform more and more to show some dynamic visualizations of the market. But this is one of the views that I actually use at my desk in the office here. And it's looking at a particular stock like an Amazon. And I have the daily chart going back for a year. I have the weekly chart going back for 5 years. And then I have a candle chart just to make sure I'm identifying, really focusing in on where we're at relative to key support and resistance levels, any candle patterns that might pop up. The fact that we're at the 200-day kind of jumps off this chart to me. But I'm also seeing how this last month or so fits into the last 6 to 12 months, right? Where has Amazon come from? Overall, I can see this downtrend channel below the 200-day, these multiple tests. This is not the first time Amazon's tested it. It's happened a bunch of times, and that makes a real question mark for me. I can also, by the way, focus on earnings and all these other things that are going to impact it. Amazon, by the way, reporting next week on Thursday the 27th. Then I can see how that little chart there fits into the bigger picture. And one of the really cool things you can do on ACP is zoom in and out of each of these. So Joe Rabel actually shared one of the 5 chart views that he uses. I was actually going to tinker around with that over the weekend if I had some time. Looking at 5 different time frames and zooming in and out. So the short answer is 100% I would use them. And I think it's really important for you, the way I would encourage you to explore using ACP to do that for now is to think about what's the time frame you're operating on. So for me, it's really thinking about the next 1 to 3 months. Generally speaking, that's kind of what I'm thinking. But there's also a shorter time frame. So for me, it's looking at the last 20 days of trading, 30 days of trading. There's also a much longer term time frame. And so for me, looking one larger and one shorter in terms of time frames is really important. The charts and the time frames you should use is really a question you should ask yourself, right? What time frame are you tending to focus on? And then do one larger and one smaller time frame and use a couple charts to help you understand the relationship between those time frames. Pay attention to support and resistance levels, to moving averages, to indicator signals on those multiple time frames. And if you want more about that, Joe Rabel does a great job on his show, Stock Talk with Joe Rabel, of illustrating the benefits of multiple time frames. Great question there. Next one. What is the best way to chart inflation on stock charts, and why are the FRED, BLS, and exclamation point PRII charts all different? So those of you that aren't familiar, we got some acronyms happening here. FRED is the St. Louis Fed's website. It's a database, a freely accessible database. It is a wealth of data. We have certainly some of their data into stock charts, but not all of it. And I've often found it's easy to take data from there, to export it, and then put it using our user-defined index. It's actually an easy way to get some data into our platform. BLS is the Bureau of Labor Statistics. They actually publish data on inflation as well. Exclamation point PRII is something a little bit different, though. So your first 2 questions were about inflation data, right? So the FRED database, which is a Federal Reserve site, actually gives you raw data about about inflation, CPI and PPI numbers. Bureau of Labor Statistics produces some cool visuals, which I've used before, which show you the change in those different figures. Exclamation point PRII, which you asked about, is a daily index that Martin Pring asked StockCharts to create years ago. It's actually not looking at inflation data. It's actually looking at inflation-sensitive stocks. These are stocks that tend to be inflation-sensitive. So be careful there. You're not actually looking at inflation data. You're looking at stocks that are tied to inflation. There's also a PRII deflation index, and if you want to find those, type them into the top here with the keyword search. Hit the exclamation point if you want to know about what those indexes actually track and some of the things. But what your question is how do you actually chart inflation? Here's how I would do it. We have an index, double dollar sign CPI. This is a seasonally adjusted consumer price index. And by the way, just recently I was talking with Julie Stekempener, who's helping us manage our data efforts here at StockCharts now. Talked to him about some other economic data. We have a new data source we're integrating into our platform. Hopefully very soon we'll have a much richer database of economic data for you to break down. So we're working on it. But for now, here's what I would do. Double dollar sign CPI is actually the raw consumer price index number. So as it's going up, you can see it sort of steadily is inclining, and that's just how the economy is growing over time, right? And prices overall are increasing over time. So it's kind of a boring chart here, and I literally, if I make it a super boring chart, you can see the raw data is just kind of going up. What you want to do is make it a monthly chart, because CPI data is reported every month, and add an indicator called rate of change, and then make it a 12-month rate of change. Let's see, how do we make this a little bit prettier? We don't need open, high, low, close. It's just sort of, let's see, we could do an area chart. That's pretty. And we do that, and then we can bring in way more data, so we can bring in like 10 years of data. All right, now what I'm basically doing, and I'll make this a little bit higher here. So up here is that raw CPI data. You can see it's sort of overall trending to the upside. This down here is the headline that's usually going to be reported in the media, which is the year-over-year percent change in the inflation data. So that when we say the inflation target's 2% and we're up to 9%, we're down to 0.5%. This is the series basically that you're going to be looking at. This is kind of a backwards way to get there. Add this index, double dollar sign CPI, do a 12-month rate of change. We're going to make this a little easier for you. This is something we're talking about internally, so we'll get that set up for you, and I'll report back when we're able to do it. But that's how you can look at that inflation data and how it's changing over time. That's the number you probably are thinking about that you want to pay attention to. Great question, by the way. Next question. I read that the OBV, the on-balance volume indicator, could provide a good clue to a sudden reversal in a stock's trend. Which indicators might you recommend? And this was the chart that you shared. Again, I really appreciate for those of you that send charts to us, just use the permalink, which means right below the chart, click on permalink in ACP. There's a little button in the lower left, a little arrow to share a link. Just send that link in with your question. I can look at exactly the chart that you're asking about. Makes it a little bit easier. What indicators might I represent? On-balance volume isn't bad, right? So my initial answer, volume, right? Just the daily volume reading is often considered to be one of the better ways to do it. Now, this is what I learned 20-ish years ago when I was learning technical analysis for the first time. I'm reading John Murphy and Martin Pring and Edwards and McGee, and they're telling me that looking at volume versus price tells you what the institutions are doing, right? Because if the market moves and it's on heavy volume, that means it's institutions doing the buying. If the market moves and it's a much lighter volume, then it's probably more retail investors doing it. I will tell you that's a fairly antiquated, overly simplistic way of looking at the daily volume reading. So there are a series of indicators that have tried to make that a little more accurate as a way of measuring institutional flows, right? Price movements on big volume. On-balance volume is Joe Granville's version or way to improve on a basic volume reading, which is basically taking the daily volume reading and making it bullish or bearish volume or up or down volume based on the movement in the price. So if the stock or ETF is up on the day, then that day's volume is considered positive. And if it's a down day, that day's volume is considered negative. That's sort of like a sledgehammer approach to analyzing that data, of course. So there are other techniques as well. We don't have time to go through all of these, but I'll point you a couple that I would suggest you look at. I would encourage you to click on the hourglass, look at our chart school section on these indicators to learn a little bit more about what they mean and what they represent. The two that I would point you to are the accumulation distribution line, which gets a little more colorful, and then the Chaikin money flow. Mark Chaikin actually created both of those indicators. I think they're a beautiful upgrade to the on-balance volume, which I've used for quite some time. Once I learned about Chaikin money flow and the accumulation distribution, I'm a fan of how they actually look at volume and incorporate a little more subtleties about the movements in the price. So those are some of the tools I would look at, and I know Mark and others certainly look at to think about and to track institutional trades. Next question. This is a great one. This could be an entire webcast, so I'll give you the short version, but I promise I'll do it. I'll talk more about it when I can. What future role do you see that AI will play in the process of trading and investing in stocks? That's such a fascinating question. It's a big one. But here's what I'll tell you, right? I've been asked about things like this for my entire career, and I will tell you, when I started in the industry in June 2000, I was asked a similar question. It's just we weren't talking about AI, we were talking about other things. At the time, it was decimalization, which was just being rolled out on the major exchanges. There was a test group of stocks that were trading on decimals, and then they were building it out to others during that year, which ended, of course, happening. And now that's what we know. Sub-penny trading, so when stocks could trade for less than a penny, and the bid-ask spreads coming in, I was told that would break the entire financial industry because brokers wouldn't have a business anymore. Other things that I've been told will break the industry: algorithmic trading, high-frequency trading, hedge funds in general, quantitative models. All of those things I've been asked, like, obviously this is going to break the fragile industry and the markets themselves. So what happens? I will tell you that if you talk to people like Ralph Eckenpour and Luis Yamada, who I will be interviewing soon on at the CMT Symposium, they will tell you that their role 50 years ago in 1973 was more of a chartist, because the job of technical analysts was mainly updating charts for about 90% of the time. The last 10% was where you actually analyzed the charts and then talked to people, marketed it, right? Now I'm able to spend about 5% of my time creating charts because it's all automated, and I can spend most of my time thinking about them and talking about them and debating them with others. So I still have a job. It's just the nature of my job has changed very much from what Ralph's job was 50 years ago. Bank tellers and ATMs are the other one I would think about, right? When ATMs came out, I was told bank tellers and bank branches would go away. I don't know what your town looks like, but there are more bank branches now probably than ever before, and there are still a lot of ATMs around, even though they're going away. There are still people that work at banks. Their role has changed. They're not handing dollars out anymore. They're helping you figure out more complex things. So I think the roles will evolve as they always do. I think AI will be used for really capable things, and man plus machine, or human plus machine, is the best combination to focus on. My producer tells me I am now done answering that question. Let's go to the 3 and 3. 3 charts in 3 minutes to make sense of this market environment. Let's get right to chart number 1. In our market recap, our Wrap the Week segment, we were talking about the McClellan oscillator. This Christmas colored chart, the green and red, is really meant to highlight the strength and weakness as defined by the McClellan oscillator being above or below zero. We are right at that zero level, and I think going into the close here, I'm not sure exactly if it'll end up going below it. This isn't updated for today's close yet. I think it actually might go below zero today. If that's the case, you have to look back to these red shaded areas, because every time here over the last 12 months, that has meant a drawdown. Not maybe the end of the world drawdown, not a new low, but something not going up anymore. And I think that might be an important thing to pay attention to for the major averages. Chart number 2 is Amazon. We highlighted in our market recap some of the stocks testing their 200-day moving average. Amazon testing it from below, Valero and others breaking down. There are other stocks that are actively testing support and resistance levels. Our predefined technical scans give you a great way to identify some of those charts that are actionable that you may want to focus on. But I will tell you, Amazon in particular is a mega cap name. It's one of the biggest names in consumer discretionary, over $1 trillion market cap. Not many stocks can make that claim. So what happens to Amazon has very much a market moving possibility. If we stall out at the 200-day, like we did back in February, that was kind of a painful little stretch for stocks in general as things were coming off of their new swing high. I'd be very curious to see if Amazon can close above and follow through above its 200-day moving average going into next week. Finally, the Dow Jones U.S. Trucking Index. We didn't talk about this at all today, but I was scanning earlier this morning thinking about how the week had evolved, and I look at our Dow industry groups, about 106 of them that we have on the StockCharts platform, and we can see which ones are changing in terms of their scooter rankings. So the trucking index, the trucking group, is the industry group that has had the biggest gain in the scooter rankings over this week. It's not the top ranked one, that's renewable energy equipment, but it's the most improved. And when I look at this chart, when I think of stocks like ODFL, TFII, JB Hunt, CHR Robinson. These are all names within this group, and a lot of them look very, very similar, bouncing off the 200-day and rotating higher. Is this the time or an opportunity to ride a group like this to the next leg higher? Folks, that is a wrap for the show and a wrap for this week on The Final Bar. Thank you so much for joining us. We will be out next week, but The Final Bar will be going on, hosted by Tom Boley, and we'll be live from the CMT Symposium next Friday. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.